Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. So good to be here with you today. And I'm speaking to you, Ben. I see that smile. And Dan. Yeah, it's good to see you guys. How are you today?
Good. Just spend the last 20 minutes laughing in the studio. I think it's going to make this an interesting show, for sure. So how are you doing? How you doing, Dan?
I'm doing good. It's always a good day when we get together to record. You know, it was a good time.
Except for when you show up, Dan.
It is. It is. It's really good of Ben to not push the record button until we're ready, because there would probably be some kind of blackmail out there for us later on in life. But we're having a great time here today, and I think a lot of that has to do with what we're going to be talking about. We're going to be talking about the state of mind, being in a bull market state of mind, or that New York state of mind around your finances. I'm in New York state of mind. And we just have a hypothetical out there. If in 5 years you know the market's going to be up, and let's just, whatever that is, up big, how do you, as an investor, invest today with that knowledge and that confidence? It takes something to get there. And that's what we're going to be talking about today, is getting you there into that New York state of mind as an investor today. Cannot wait to jump into that with you guys. And I feel like I'm going to get ahead of myself here because I'm just so darn excited to get into the content. So I'm going to step away from the mic for a little bit and just take a breath.
Well, you know, we talked about grin and bearing it the other day and last week or whatever, and you know, so many people who are just scared to death. And how do you change that framework? How do you look forward? How do you move forward? You know, you're either pre-retirement, like getting into retirement, like you're 62 or 65 trying to figure it out, and you might be completely engaged in retirement, and you have this portfolio that you're feeling some sort of, you know, financial pressure on the downside that maybe feels unhealthy or it's unwelcomed at this point. And you're questioning whether or not you're even in the right investments to begin with for where you're trying to go and what your goals are. I think we're going to do a pretty good job to kind of cover those three states of mind that people are in as we, you know, continue down this road of how to deal with this market and the turbulence that keeps sending the market up and down, and it just seems like no one knows where it's going.
Yeah, I think, you know, one of the effects, and as we kind of prepare for these things, you read about strategies and bear markets, and one of the things that I've come across that kind of individual investors will do is, you know, when the market's down, they almost get paralyzed. They just hold and wait. You know, when the market's up, that's when they're taking opportunities or taking the option to look for opportunities when they might want to consider doing a little bit of the other way around, right? The market's down, you know, some stocks are probably at a discount, and the opportunity to kind of reallocate, even though you're potentially realizing some of those losses, but to find the right opportunities to get back in, you know, so that, you know, you just don't lose that opportunity to better yourself now, get better returns, and then, you know, as the market upticks, have yourself in a diversified portfolio that's just going to perform really well.
I love it. I love it a lot. Before we get there, we are going to jump into Money in the News.
First up, we got an article here from Yahoo Finance. Consumers remain the Fed's biggest problem. This comes to us from Miles Unland. And what the article's about is, you know, we've discussed at length here, and show after show after show, what the Fed's doing with the interest rate to try and drive down inflation. And they've done it with the stated goal to achieve a couple different things. You know, one being to increase unemployment, and the other to reduce consumer spending through all the supply chain crisis and all that. But, you know, while inflation is kind of tailored off and stabilized and, month by month, it seems to be inching down a little bit. One thing that the Fed moves have not really taken effect on yet is consumer spending. The economy's still good in general, and, it is a consumer economy here in the U.S. 2/3 of it's made up of consumer spending, which includes things like shelter, food, clothes, vacations, all, everything that we spend money on. But with housing being such a large piece of that, the spending continues to be going at kind of, when you take out the pandemic, we're at about a 10% increase over pre-pandemic levels. And that's following, 400 basis point raises by the Fed, in the last year or so. So that kind of linchpin, that metric that they're looking to start easing up on the Fed policy as it is right now just is not really happening.
Yeah, I would say that there's so much going on with the Fed, and they're going to continue raising rates over and over and over again. And they've said it, and they keep saying it, and we are literally staring, double-digit rates right down the barrel. I mean, it's going to hurt. It's something that is really driving a lot of fear in the consumer, but the overall consumer base is still spending because we have what people don't realize is that it's kind of like riding the wave. You're like, even body surfing in the ocean. It's like, that whole cash is just continuing to fly behind him at that spending spree. And eventually it's going to subside, and it's going to subside significantly farther down. And the Fed has said we're not going to have a soft landing. We're not going to have any of the things that we're really looking for. And that's a scary point for a lot of people. So, we did an article a little while ago, a few weeks ago even, where the Fed we talked about how, GDP was up compared to the previous year, but it was actually down 50% from the other perspective. And you and I were joking around about that in the hall the other day, and I was just like, you can take a glass half full or you can take a glass half empty. I mean, but the point of that scenario is that with, construction and, all the infrastructure piece being the half empty portion that we're experiencing, the entire blue collar workforce is it is the small business of America. That is our primary role in the small business space. That's the electrician, the plumber, the contractor, the laborer, all of that stuff. That's where all the spending's coming from. So as they're flush with cash, that's what's driving a lot of this. And I think as you've just cut the knees out at that for most of the country, and for people in New Hampshire and New England, specifically New Hampshire, they actually did a news report that New Hampshire is one of the least affected states because all the people are flooding New Hampshire from the surrounding New England states because of its more conservative approach to things. And, their voting won't change, which is kind of the joke that goes on. But that's why New Hampshire is growing. You can't find properties. You still can't find builders. But the rest of the country has had this complete cliff falling that we're not experiencing here locally. And that's really very interesting to me.
Yeah, there are going to be pockets that are insulated overall because of, different things going on, like the demographics, the change in demographics, or the change in the job landscape. It's interesting how the Fed is at a bit of a tussle here with you and I, the consumer, because they want things to level off and to come down, and we're out there still doing our stuff, and we're living our lives, and we're still employed, and we've still got we're still flush with cash apparently. So away we go, and that's what we do. Is every red-blooded American goes out and spends that cash and puts not the new high-end TV on the wall. Apparently, that's what some of the information is telling us, or not the high-end jewelry. Those are some of the areas that are being affected. But the rest of the sales can continue to be around 10%, which is a fairly healthy number out there, and the one that the Fed's going to continue to take a look at and try to bat down a little more. Moving on, as we're talking about spending, this is a nice thing to see, is a little bit less spending that I've been doing at the gas tank lately. But apparently that might change a little bit here. OPEC is going to cut their oil production for gas. And what does that mean for us? That means that we're probably going to see some prices going back up. What we've experienced nationally is a leveling off or a pullback in that gas price. Right now, we're at an average across the United States that is about where it was at last year. And I remember over the summer looking at the gas station driving by downtown Portland and said, holy cow, it's $6 a gallon. And Kira looked at me like, yeah, you didn't know? No, not out here in Hillsborough. That was, I knew we were somewhere mid-fives on our regular unleaded, but holy cow. I was grateful to drive up and only pay like $3.86 or something like that the other day. That felt good.
Well, that's interesting because, they said that gas prices are like 5 cents higher than they were a year ago. So we climbed a mountain and we come back down, but we're still twice what we paid 4 years ago. It's kind of horrible.
Another half full, half empty perspective there, right?
Yeah. So grateful to only be paying 5 cents more a gallon, Dan.
Well, it's less than inflation on everything else, I guess, right?
Well, this is really interesting. So OPEC has basically said that, they're going to even out their gas production. They moved it up because Biden asked them to move it up 2 million barrels a day, and they did that. And it looks like they're coming back down, and it's going to even out and be a flat for the overall production from Biden's request. And what does that mean for gas and oil? I mean, they're going to be producing 2 million less barrels per day. And, we are just looking at, oil was at an all-time low for the year, per barrel the other day. So that's really very interesting to me too. So they're realizing we're on a downward swing there. And they also know in the back of their mind that, with these increasing rates that are almost globally, again, there's like 3 or 4 countries that are not raising rates, actually lowering rates, happen to be all of our enemies. But that being said, they do know that there's going to be an economic slowdown. They do know, and they do know the same numbers we know. They do know that our infrastructure is being cut at the knees nationwide. They know that demand portion is going to come down, so they don't have any reason to raise it. Raise the production because they ultimately know that the demand should, based on what the Fed is saying, be significantly slowed. That being said, I still think right now at the current oil prices, there's an opportunity even potentially in energy just because of it's not like the whole oil consumption piece. Like people are still using Amazon. They're still there's still going to be that consumption. But what people don't quantify is that even though we're moving to EV cars, there's very few homes that run on just solar. Like there's very few homes that will just take care of their own electricity. Like most of the grids in the United States are powered by oil. They're not powered by wind. They're not powered by hydro. Those are all portions. That's just a very, very small portion of the energy creation we have. We have a super long road before we could ever count on oil not being supported. So looking at everyone's iPad, iPhones, you start looking at it, the demand for oil continues to increase year over year over year. I was talking to a woman from a large management firm, and she was head of their IA team, and I was talking to her, and she's like, yeah, people don't see the demand of oil still growing no matter what really happens because everything we do becomes more electronic than it ever was before. And even though we're using lights that are less demanding and all of these different pieces, our oil demands continue to grow, even though our EV piece and creating the alternative energy space is growing at even a more rapid pace. Our demand for oil is still growing. We haven't even caught up to flatten demand on oil. That's really scary. And in 2023, we have some big, solar initiatives coming from the government, and that's interesting.
And a big driver of this is, geopolitically kind of twofold. The China response to COVID is expected to cut demand big time there. So that's one of the things that OPEC is using as a justification for the move. But the other is the price cap that's been suggested in the outright boycott by Europe on Russian oil, which, just kind of my own theory here, I think whenever OPEC hears of things like that taking effect, whether it directly impacts their production or not, they're going to kind of buck against that. They're not real fond of seeing political influence and restriction on producers, regardless of what they're doing in kind of human rights realm.
Well, I think that's because they're all suspicious too. Right. They're like, well, we don't want to be punished when we decide to do that.
The Saudis got plenty to worry about when it comes to things like that. So, they hate seeing those kind of moves and seeing, kind of nations unite around kind of blackballing one producer. And I think it's unfortunately to all their benefits to manipulate this market the best they can, and they'll continue to do so.
Well, as they continue to shove this thing down our throat about how we're going to be completely alternative, and 2050 we're not going to use any of these oils, and 2035 California is not going to sell an oil-based gas vehicle. They're still going to be consuming oil to power the grid that they never took care of for the last 30 years or whatever, or 50 years. And there's just so much misnomers of what we can actually accomplish. It doesn't matter which side of the political stance you stand on. If you really understand energy and you really understand consumption and the demand and where we get it, you don't understand necessarily if you think drilling oil wells and fracking is bad. Well, that's great and all, but stop driving a car, turn off your cell phone, go live on a farm all by yourself without a tractor, because it's not going to change. It's never going to change. The demand is only growing, and the technology that they're shoving down our throats is only requiring us to grow in that space. And I'm all for alternative energies. Dan knows that. I mean, that's my number. I love it. I think it's a great thing. The problem is the reality and the technology are not here for what we have, and we can create all the initiatives that we want. But the truth is that they have to financially encourage us through tax breaks to put this stuff in place, because it's so expensive, and it's just not, the technology's not there. I mean, the reason it's so expensive is because you need, not just one, 2 by 4 foot panel on your house to solar power it. You need 25 of them, and they're huge. And by the way, they collect so little solar that by the time you get to the winter, you're only half powering your house. So there's just the whole thing is just not well balanced, and the technology is not there yet, unfortunately.
No, not yet.
Speaking of, this is not necessarily the newest of news, but Shell building a hydrogen plant, or converting their plant in the Netherlands to a hydrogen plant by 2025 is what that plan looks like. It's pretty amazing. It's they've just gone ahead and said, no, we're all in. And other energy suppliers are saying that that's not the direction that they're necessarily going to go. But it's a pretty cool plan. If you take a look at what they're doing, they're going to be putting up those those giant windmills like you guys have off of Martha's Vineyard out there that you guys that they're putting out in the ocean. I mean, they're absolutely massive in comparison to the ones that we're used to seeing here on the Columbia River Gorge and across the plains and stuff. But that's part of the plan too, to generate the power in order to create those to fuel that hydrogen plant for Shell. For what are we talking about? Shell.
Well, yeah. I mean, the thing is and I've talked to people in this space quite a bit, and it clearly looks like clean nuclear is the answer. I mean, it's still nuclear power. It's just gonna be cleaner, and then they throw the word clean on it, and it sounds a little better, and everyone's like, well, let's take that out. But it's still nuclear. It's still waste. It's just a little better. But that sounds like that's really the direction people are going.
And I haven't fact checked this yet, but helium-3 seems to be what the largest discovery that China had on the moon, and their plans to be able to mine that they're not necessarily sharing with the rest of the world at this moment. But that was the that's another money in the news. Let's go, guys. So why is your credit score so important? Well, it makes a big difference if you're out there shopping loans and you're in the loan market. It can make a huge difference in how much you wind up paying. But right now, we're actually experiencing something we haven't in quite a while. Since the 2008, the national credit scores have been going up year after year. But this year, they've actually leveled off at an average of 716. Still a good credit score, but something that's interesting to take a look at. I mean, I guess as far as the consumer goes, maybe we're not as flush with the cash as we used to be, and are relying a little bit more on credit and some of those other factors that are leveling off our credit scores.
Yeah, and this is coming out of an article from Jessica Dickler here discussing the national credit score. And, there's a couple of important takeaways that I got from this article, but one of them being that you just mentioned this, at the national average at 716, which was shockingly high, what I was expecting to find there. I thought it would be considerably lower than that. But it does give a ranking as well of kind of states and regions, what their average credit score there is. And New Hampshire showing up well at number 2, and a couple of New England states in there as well. But to your point, Seth, about the kind of the impact of a credit score, they give you an example here, and they let you know that every 20 points kind of makes a big difference. But if your score is 760, you could lock in a 30-year fixed loan for a mortgage rate of 5.75. But if the score jumped to 640 or below, or dropped to 640 or below on a $300,000 loan, your rate there would be 7.3%, which would add up to a $113,000 difference over the life of the loan, which is astronomical.
That's crazy.
So, really important to keep those things down. And kind of a takeaway tip there for credit monitoring is to make sure that you keep your revolving debt at 30% or below of your overall total limit.
Folks, that's going to do it for Money in the News. And when we come back, we are going to get into that New York state of mind, that bull market state of mind. Cannot wait to jump into this show with you guys. We'll be right back. You can reach us at 855-226-8551 or info@yourmoneyontap. We'll be right back.
Ben, how often do we have somebody come into the office and they don't have a financial plan? And how critical is it for us to put the pieces together and make sure that their future, their retirement, is a successful experience? We talk about it all the time here at Money on Tap. If that's you, give us a call at 855-226-8551 or info@yourmoneyontap.com. Whether you have 100,000, 500,000, 5 million, look, folks, we have the right planner for you. Whether it's Ben or myself, Seth Krussman, we're here for you to get the plan together and make sure that that next step is right.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
All right, welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And Ben, Dan, I just realized something. No one will ever know how many times I've messed up the 800 number. And and we've had to stop and do it over again. It happens. It happens. It's just part of life. We make mistakes all the time. And you know what's great is we get an opportunity to make up for that. We're going to have a better show here for you because, you know, I've just made so many mistakes to get it to this point. And we're talking today about having a bull market state of mind. Like what in the world are you talking about there, Seth, having a bull market state of mind? Well, for one, when things are in flow or when everything's, you know, going well, what's going on inside? How do you think? How are you paying attention to stuff or life differently versus, you know, the sky is falling and the world around you is crumbling? We're talking about fear when we talk about what that feeling is like. And what does that do inside of a person that's trying to make a decision? A whole lot. It makes a huge difference in how you approach life, how you approach ultimately your retirement planning process. And one of the things we focus in planning is trying to run some tests and trying to put together a plan and say, hey, we know that there's going to be periods of time where it's going to get a little dicey. It's going to get rough. What are you going to do, or how have you built yourself and your plan and put your plan together to weather a storm, to go through a hard time? Bear market, bull market, you know, ups and the downs. We want to make sure that we're investing in a way that's going to, you know, prevail over a large amount of time. The outcome is going to be the one that we're looking for. And so part of that is taking a look at what our frame of mind is. And we're talking about that in a bull market state of mind and getting ourselves into that place where, you know what, we're making the greatest decisions possible and taking the best step possible forward for ourselves right now. and we're recognizing that it might be that there's fear entering into this process of how we think or how we feel, but it's not going to dictate to you whether or not you're going to be successful.
Well, I love a lot of what you just said, Seth. Not all of it, but I love a lot of it.
And it's okay. You can love all of it.
I love all
I'll
of it.
give it to you.
You know, it's funny because people there's a very well-known understanding of fear of losing your money, right? That's people invest in the stock market with a fear of losing their money all the time. They're saying, hey, I put this money in, I buy a stock, and guess what happens? And it goes down. I mean, I could ask 1,000 people, and every one of them would say that because we don't make the highs or the lows. If a stock is going down and you buy it, it's going to continue going down. If you buy a stock and it was on its way up, it's probably going down. It doesn't really matter. You sell a stock, it continues going up. It doesn't matter who you are. Everyone is in that context, and it always feels like that because you're never going to sell at the high and you're never going to buy at the low. It's a fact of life, and there's all these computer systems out there making sure it doesn't happen with you. So. But that being said, there's also another fear. There's the fear of not making all the money you can make, right? So one of the competing aspects of not losing your money is not making money. And people don't recognize that that's a real fear. And I think one of the things that helps people avoid that fear is the ability to put your money on the sidelines, to step in the void and say, I'm not going to be in the market right now. And I'm not necessarily saying that that's the advice we're giving here today, but I mean, even in our managed portfolios, a portion of our money has been sitting on the sidelines since April. We have literally went to cash on a portion of our assets back in April automatically when it broke the 200-day moving average on the S&P 500. The market started declining below a kind of a standard norm, and a portion of the money instantly went to cash after a 5-day period. Like, that takes an entirely different approach, a different fear of us saying we're going to cash based on our fundamental analysis on this portfolio, and then the fear of us being wrong and the market continuing to rise. There's a whole separate fear of losing money if not making money. And that's the bull market state of mind, right? Everyone wants to be like, hey, the market's down. How do I make money? But recognizing both sides of that fear, why do we invest? Why do we overinvest? Why do people live on margin? Why are people always 100% engaged in the market? And so as we're talking about this show today, which is a bull market state of mind, and kind of embracing where it's at and how to turn kind of a troubled market, a bear market, into the right direction for you is going to be our focus today. And I'm excited about that because that is really where a lot of people lose focus on how to engage or address these pieces. Now, if you were someone who wanted to go to cash on the S&P 500 back in April because it broke through the 200-day moving average, well, then you should be on the phone with us and calling us and see how we do that and see what we do in that space. I mean, we actually have portfolios, and Seth and I were joking around about this the other day. It's like almost embarrassing to say we have portfolios that have made money this year. It's hard to say that we beat the market in certain areas. It's hard to say that we haven't lost as much of the market has lost in, I think every portfolio, but I would say almost every, just to give us an exclusion of saying, hey, there's something out there that might be different or in line with the market. But all the managed work that we have been working on, we have put certain rigidity in place to try to maximize against that because we're not afraid of missing out on returns. We're more afraid of how much you'll lose. And that's really the best way to manage a portfolio is to manage loss.
Yeah, I think, there's a psychology to it that we've all long understood, that the fear of losing, hurts worse, or recognizing a loss hurts worse than, the joy of making a gain. And, I see it myself, and when I look at my own trading account, if I flip it open today and the number's higher than yesterday, I'm happy and I move on. If it's lower than yesterday, I start looking at individual positions and I say, well, where's this bleed out happening from? So the whole level of, kind of diagnostic analysis goes up, and it's a different perspective even for me, when I'm looking at a downtime. But, the reality is when you're managing portfolios and when you're preparing for retirement and looking at your own retirement account, you need to think long term, right? That's not money you're planning on withdrawing tomorrow. So today's fluctuations, up, down, sideways, are less significant. You're really looking for the long-term trend. So thinking long-term is really the play here. That's the way you need to approach it, and just understanding the conditions we're in. There's in a market correction, which is about a 10% move to the downside. That just happens with trading volume and different factors that kick in. But then you have the bear market scenario, which we're in, and we're trying to help people see their way through. And that's when you're down 20% plus in any given index. And, sentiment is low. The market gets emotional. There's a kind of a state of panic out there that triggers a lot of trading, not only at the individual level, again, that fear taking over, but, as well at the institutional level, particularly around year end. And we've done some shows around that, right? So
it's like that self-fulfilling prophecy, right?
Yeah.
Like the market's going down, it's going down. I might as well sell too because I might miss something.
Yeah, and you and several million other people are all thinking that, right? So and that's what drives it down.
I think it's like 20, 50, 100 million people. But yes.
Whatever it is, it's a lot. And the effect on the market's clear, right? You get into these kind of downward spiraling moves. But the right approach to that is presuming it's within your tolerance. And for some people, the move to cash is just the way you got to do it just to sleep at night. But if you have that long-term perspective and kind of have the appetite for it, you recognize it for what it is. It's a downward move temporarily in what's a long-term investment strategy for you. And there's ways through that. So positioning some of your investments into cash like we've done in some of the portfolios is a good way to do it. You don't want to exit the market entirely, but for positions where you either want to take a loss now before tax time to offset some gains, or things that you just believe that economic conditions aren't going to sustain favorable growth, we get out of those, move to cash because opportunity exists, right? So you want to be poised to jump.
Well, I really appreciate the think to long term, and we talked a little bit about that plays a real role in somebody who's pre-market, pre-retirement, or that money is for later in their retirement and they are retired, right? So you got that long term perspective, but there's that whole short term perspective, like where should my money be for tomorrow, or the next 5 days, or the next 5 months, or the next 5 years? Where is that? When we talk about long term, I mean, we're all thinking, north of 3 years, most likely north of 5 years. So for our listeners, that's kind of what we're thinking of for a long term perspective. And we did talk about how, every 19 midterm elections that year has been positive, from November to November, with an average of a 16% return, and we're staring down the barrel of a recession. We're being told, so. It's hard to look at that square in the eyes and say we're in a good spot, but I do think that the market's going to be up a year from now.
Yeah, when you look at kind of some averages and some history, bringing up the 19 straight midterm election kind of 12-month results, the average bear market has gone on for 9.6 months. Okay, but you contrast that with the average bull market, which is almost 3 years.
Right.
And what's interesting, too, and to kind of dive a little deeper into those trends, is that half of the S&P's biggest days have taken place in a bear market. Mm. So that all just lends to the point that you don't want to totally exit the market. You want to be in. If you need to peel back and go to cash with some of your portfolio, you can certainly do that. But there's good days in there, even in the bear market scenario, that you just don't want to miss out on entirely.
You know what? I'll go ahead and set my ego aside and just say that I loved everything that both of you said. Okay. And, and also that in terms of the portfolios, there's so many different ways to construct a portfolio, and some of the funnest ones that I've had have been the biggest failures just to watch. I haven't had money in them necessarily, but like I go back to, I think around 2010. And Money Magazine came out with like the top 100 companies, and I couldn't tell you any of the companies except for Green Mountain Coffee was one of them on there. That was a big deal. The Keurig cup was coming out, and that was really doing stuff. Anyways, I created this portfolio off of all of these 100 companies, equally weighted, and I just wanted to see, does Money Magazine have an edge on what the market does, or what's going to happen from this point forward? So many of those companies wind up becoming busts, and they're fads, and it's interesting and it's fun, right? Those are, as long as you're not like, putting a lot of money in those ideas. But what happens in that process, if you're willing to participate You learn, you grow, you find new ideas, but then you find, hey, there's some strategies out here that over time have been proven out really pretty well. Large numbers, statistics, that 200-day moving average that Ben was talking about. What is that? The market, you can take a look at it, moving average of, 25 days, 50 days, 100 days, 200 days gives you a pretty good sample of what the market's been doing for that time. And it will usually provide an uptrend or a downtrend. And if you're using that as a gauge and seeing that the market started to roll over and go down, that 200-day moving average has gone down, and if you see the difference between that 200-day moving average and the market, where the market's priced at, over a period of time, stay in relationship in that same correlation, statistically, that's been proven fairly well to go into cash, to get out of the market. And that's what Ben was talking about back in April that we were looking at. And what do we continue to maintain? What's been different about some of the market over the last several years is how quickly it moves. So we've got some data that's been really proven out over a quite a long period of time. And we'll say, pre-2017, but post-2017-18, the market movement got so volatile and so big that some of that just didn't test out the same way. So so that's where you just don't stick all your eggs in one basket, right? You're not just like all in on that idea. That's not diversification. It's one that might help to guide, but you got to know the rest of the landscape, because we've used that 200-day moving average in that same scenario to help us, to allow us to get that out of fear, and into this mindset of what's going to work best and why. And then to be also able to pull the levers or make different decisions, because we see other things happening that maybe that 200-day moving average isn't going to test what we feel to be the truest sense of, or to test in a way that's going to allow us to move in and out of the market the way we would like to be able to take opportunities the way that we'd like to. All that being said, you guys, there is so much more stuff that I'm just going to keep going here. I need to set aside that whole thing and just go into a break, give you guys a breather. How about that? And when we come back, we're going to talk more about the bull market state of mind, how you guys can get out of fear and into the mode of being a successful investor. Grab hold of your plan, grab hold of your portfolios, grab hold of this moment and engage. We'll be right back. 855-226-8551 or info@yourmoneyontap.com.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. 855-226-8551 or info@yourmoneyontap.com is how you can get a hold of us today at Brayshaw Financial. We're all planners and partners here at Brayshaw Financial. We're talking about bull market state of mind, that New York state of mind. How do you, as an investor, move aside the fear and focus on what's important for you in your planning? And how do you stay invested?
Yeah. Wow. How do you stay invested is a great one. The number one thing, when you're facing this kind of downward trend, we're in a bear market, you're looking down and so forth, the things that we're doing in our portfolio, especially the ones that we're, up for the year, trailing 12 and year to date, we're up and as of December. And the things that we focus on are quality. I think that's really where in our large mid-cap value portfolio, it is a quality-based, high-yield, focused stock-only portfolio. It's not a diversified portfolio. It's literally designed to be kind of those, household name companies that you see. I don't even think Exxon's in it, but that would be a good example of, I think Exxon's out, right? We got out of Exxon, but, we literally go through things that are, kind of like oversold, have high yield, and we're cycling through that. We kind of call that our, now money portfolio for a lot of people, where they want some current active income. People love that. What we do with that is really just focus on the people who have the money. They're not over leveraged. They don't have debt that's unnecessary. Their cash flow is strong, and we feel like the market has oversold what the demand will be long term. I mean, it's a super simple mix to that conversation. I mean, obviously we get pretty detailed and we argue about companies and so forth, but and I mean that in a good way. We're not like angry at each other, but we debate it out. We get serious. We get down in the weeds on this stuff, and it's fun for us. It's boring for everyone probably listening, so we won't go there. But that piece is really where it is. And I think if you want to have a bold state of mind right now, this is where quality is going to present itself over the next 3 to 6 months like it hasn't before. You're going to be able to tell the difference between a solid blue chip and somebody who's over leveraged. That's going to be what's going to be staring us, in the face right now.
Yeah, I mean, we were talking about it offline, but there's a number of, taking an eye at a portfolio like that or looking for opportunity. Tech stocks have just gotten absolutely hammered to the point that, at the height of the pandemic, tech stocks had PEs, some of the hottest stocks running in the thousands. I mean, they're truly priced out of this world. And they've come back down to almost a value standard, and then some are even there.
Well, so the PEs, this is all over the place. I mean, you look at a Microsoft, its PE is much higher than some of the other tech companies, which are showing just as much strength and potential growth opportunities that exist, and they've just been oversold. PE, comparisons.
Yeah. I mean, there's no doubt that, this kind of flight to quality has taken place, but what was quality 3 months ago, that I think that field of quality is widened out. I mean, there's a lot of opportunity there. But, another way to take a look at this, focus on quality perspective of a market like we're in right now is taking a pick at sectors you like. I mean, this market has been really rough, but, for people who've been exclusively energy invested, it's been a great year, right? I mean, the energy ETFs are up 50%, some of them year to date, when the rest of the index itself is down 20, 25, 30, depending upon which index you're looking at. So, I mean, there's a wide swing between kind of those two investment options. So rather than just playing indexes in a situation like this where there's so much economic pressure that a lot of companies are getting dragged down, which will therefore pull down an index, and you have institutions and funds looking to capture losses to offset tax liability for their shareholders. There's further kind of steam probably coming out of the index returns through year end. But if there are sectors out there that you believe in, and there's certainly sectors we believe in, there's great opportunity there. There's a way to get invested without necessarily having to pick individual stocks and still get some diversification of brand within a specific sector that might have some upside in it, even in the short term.
So one of the things that you guys were talking about was the PE ratio. For anybody that's unfamiliar with what we're talking about, simple way to understand what that is it's the price to earnings ratio of a company's share price to its earnings per share. So a high PE ratio could mean that the company's stock is overvalued. All right, people have, we're in an inflationary period. You're looking at gas at like $6 a gallon. You're like, holy cow, I don't think that's the right price for that. I think I'm willing to pay closer to, unfortunately, $3.50 still. That seems to be like the current going rate on gas. But anyways, it's an understanding or a relationship around where the market has priced in or what you can buy a company for today versus, maybe what it's closer to the true value of what you might want to pay for it. And so when we're taking a look at holding value and we're looking at these companies and we're trying to evaluate, what are the earnings and what's the relationship in their earnings to their price, we're looking for, something that's a decent price. We don't want to pay too much for something that we think is ultimately going to come back to that that price or rise up in that price, we want to pay a little bit less. That's the whole point of growth, is you pay less and you sell, buy low, sell high. It's just a tool to allow us to try to, analyze and take a look. If you're unfamiliar with that, just, there's Investopedia is a great way to kind of get familiar with some of these concepts. But that doesn't necessarily dictate quality, does it? I mean, quality has all sorts of different ways of looking at it and understanding. For instance, in a recessionary period, a flight to quality is one of the terms that gets thrown out there. And what does that have to do with? Well, people are leaving, like, for instance, with the tech sector, people are saying, well, we're not going to, overbuy or overspend for some of these, tech stocks that have been bought up, Tesla, Amazon, whatever. There tech stocks galore out there that have been bought up, and people have sold out of those now. And what have they started to do? Well, they've started to, put the money into the bond market. That's the typical quality that people are looking for, something more stable. But that could be a Johnson & Johnson. Why? Because everybody has to brush their teeth and do other things with their bodies that we don't say on air. And, but those are the factors, is that people are going to continue to spend money for those things. So we have a better sense of stability from putting money in that direction.
I love the fact you brought up Johnson & Johnson. We were talking about Johnson & Johnson before, and it's like you can try to time the market. Like you can try to time it, but statistically, right, if you try to time Johnson & Johnson, it would make no difference on your overall average return. And remember that, Dan?
Yeah.
It's just the performer of performers. That's kind of how that stock has been. So people have tried to time buying and selling it, and I have too. And then to hear that report makes me laugh, because I'm like, yeah, I didn't do it. So I remember listening to you talk about that, and I was like, oh man, I'm such an idiot sometimes. Always trying to get another nickel out, and meanwhile we're always telling people, don't worry about it. And so hey, we're all human. We all try to catch up with that stuff. So it's funny. But that brings me to that other point, which is, don't try to catch the bottom either. We're always trying to catch the top. We're always trying to catch the bottom. Like, just buying into the market, that dollar cost averaging, just keep doing that. Like we talked about, we have talked about 401ks and making contributions and keeping those contributions going. People sometimes stop their contributions when the market's going down in their retirement plans. And I'm like, what are you thinking? Like, that doesn't make any sense at all. I mean, we get those phone calls, and I'm like, no. This is the time you buy. We're going to shop for Christmas on December 26th when it's all on sale. That's what's happening right now. So if you could buy Christmas on December 26th and then go backwards in time, I mean, we're getting sale prices on a lot of these things. And on top of that, like the point before, they're showing their true colors. When the market's bad, companies start showing their true colors, and you can really start digging in pretty well. So.
Yeah, I mean, we've talked about this in prior shows, but if you look at, break apart the S&P 500 over 20-year segments, I mean, I think it's 100% of the time, or high 90% of the time, it's always up point A to point B. So when you're thinking about your 401k, and even if your retirement window is sometimes sooner than 20, to the point Ben always makes, is that, retirement isn't a light switch. You don't need all of your money on the day you retire. You will be spending through that account, that 401k.
Some of it's going to need 20 years.
Yeah, some of it will be there for 20. Some of it's a little bit less. But, the fact of the matter is, the way conditions have played out, there's a steep discount available in the market. You need to keep making these 401k contributions, buy through those low prices, continue to dollar cost average in, and then that way, when retirement does come, hopefully at that point in time, we've caught the wave and the market's beginning to ride up, and you've accumulated more shares. So you'll have better participation in that upswing.
What's one of the biggest mistakes that people get advice on from financial planners out there is that they plan, and they don't even realize they're doing it, but they're planning for all their money to be literally available immediately at the time of retirement. They are not planning for time horizon based investing, like, hey, I need this money in 2 years, I need this money in 5 years, I need this in 10, I need this in 20. They should all be invested differently. Every dollar should have a different perspective practically.
Yeah, I mean, no one's going to take their 401k on the day they retire and immediately roll it into an immediate annuity, which just, sets an income stream at no return for the rest of your life. That's not the way it's going to work.
Yeah.
You're listening to Money on Tap. We're talking about bull market state of mind, that New York state of mind. And you can reach us at 855-226-8551 or info@yourmoneyontap.com. Don't go anywhere. We'll be right back.
Call us today at 855-226-8551 and get your free consultation with Ben Brayshaw or Seth Krussman or any one of our partners and find out what's going on in your plan, your estate plan, your financial plan, or what you're planning at all, if nothing. Get it fixed, get it right, get it done today. Give us a call at 855-226-8551.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we are talking about a bull market state of mind, that New York state of mind, having a lot of fun breaking down some of the barriers between people and fear and investing, and how do you invest throughout a bull market. And if you're an investor, that's part of it, right? Talking about quality, talking about not timing the market. How do you continue to fund your 401k? Building a strategy and sticking through it no matter what your brain is telling you. Lots of tools and takeaways here for you guys today. And this has been a really fun show. Thanks, you guys.
Yeah, no, there's a couple of things here before we pass the baton to next week here. Building positions over time. We talked about it. Everyone should have different time horizons in their portfolio. I just talked about that. And what's funny is there's a lot of people who, will sit down with people and say, hey, listen, we made a lot of money in this portfolio, or, we want to capture some gains. We want to move things down to a lower risk position and so forth. And you've been a client for a number of years. And they look at me like, we're making money here. Why would we move that out and over here into something, maybe not as attractive or as potentially fundamentally based to make money, or maybe it's a CD at the bank or putting more money in cash. It's all about positioning money that was long-term into, shorter and shorter and shorter term. And we keep moving money down the ladder as you keep aging in to retirement. And so that's really a hard conversation, because a lot of people, they kind of miss the boat that, hey, this was long-term, but now we've lived part of that long-term. And now we're going to age some of that money into future active spending. So we're going to maybe take something that was a 20-year time horizon, and you're 5 years in, we're going to move some of that money down to the 10-year time horizon, because the other money that we did for 5 years to 10 is going to be spent over the next 5 years, and we're going to need a new bucket to grab money from. So we talk to people about that stuff across the board, and it's hard for people to analyze. It's easy for people to understand long-term investing. They've been trained, they've been taught. But understand reducing the length of time in your portfolio. If you're not having that conversation with your financial planner and you're kind of going through that, that's complicated, because you can't just put all your money away for long term, because that's how people get burned. And people do not want to get burned in retirement, and that's a big deal. But building your positions over time and really taking that's a kind of a Buffett approach, and just saying, hey, I'm in this for the long haul. This is a great company. That's great. And if you can build those positions and make sure they're ready for when you're ready to liquidate and create that activity.
And if you think you've kind of achieved where you need to be in your portfolio, or conversely, you've just kind of had enough of the up and the down of it, we do have some options that exist in the annuity space, but that can give you some comfort in knowing that, hey, listen, we might not be at the bottom, but if the market were to fall another 5, 10, even 20%, there's an opportunity there to recapture that, here in the next 12 months. And then looking forward from there, whatever potential returns exist in the index, thinking about the S&P in an example like this, you'd be able to capture all of that over a 6-year period.
Yeah, I mean, how many people want to live all of 2023 and say, hey, if the market's down 10%, I'm not going to lose a penny, but if it's up, I'm going to make money.
Right.
I mean, that's a conversation a lot of people aren't having right now, but it's a conversation you can have.
Yeah, and if you look at those stats that we brought up before about the average length of bear and bull market turns, this type of a tool would fit very nicely into what history tells us is a likely trend.
Yeah, I agree.
Folks, that's going to do it for us here at Money on Tap this week. You can reach us at 855-226-8551 or info@yourmoneyontap.com. It has been a lot of fun spending some time with you guys here talking about investing through the bear market or having that bull market New York state of mind. All the best to you guys this week. Be successful out there investing. Take care.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.